In this Pinkcast, we need to learn how to do financial reporting for corporations. I'm going to start by going somewhere sole proprietors. My spelling goes to hell in a handbasket when I'm making these. I promise I know how to spell, but I don't always demonstrate it. Sole proprietors make financial statements. They make an income statement. They make a statement of changes in owner's equity. They make a balance sheet, and they make a cash flow statement. We haven't learned that yet, but we will in 11:20. Then we moved to partnerships, and it changed a little bit, but not a lot. Partnerships still have to make the same income statement, and the accounting doesn't change for income statements. It's the same. Revenue, expenses, gains, losses, all the same. Then they do a statement of changes in partner's equity, which is like the statement of changes in owner's equity, but there are more partners involved. And then they do a balance sheet. And the balance sheet's a little different because we have partner's equity instead of owner's equity. But other than that, it doesn't change. And then they should be doing a cash flow statement as well. Now let's look at corporations and see how they're the same and how they're different. First of all, corporations still do an income statement, and the income statement is the same that you've done all along. The good news is the GAAP doesn't change. You recognize revenues and gains, expenses and losses in accordance with the current basis of accounting. But now we don't have an owner's equity or partner's equity statement. We have a statement of changes in retained earnings, because retained earnings has replaced that part of partnership and sole proprietor accounting. Then we have a balance sheet, which is just the same as it's been, except now we have the stockholders' equity section being different. And we add a statement, and that's the statement of changes in all the stockholders' equity accounts. Because now there isn't just a sole proprietor's account. There's retained earnings and common stock and paid-in capital and a variety of accounts. And we need to explain changes in all of those. And then they would do a cash flow statement as well. And all of them add their notes to it. So this is how changes come about from moving from sole proprietors to partnerships to corps. So I want to start with the statement of changes in retained earnings with you. First of all, it has its heading, the name of the business, the statement of changes in retained earnings, also known as the statement of retained earnings, and then it has period covered, and this is how the heading works. Then this will look familiar to you. You start with the beginning balance, the amount that it showed on the last balance sheet, and you add in some stuff and you deduct some stuff. You would add in net income, and you would deduct dividends. You also might deduct treasury stock transactions. That could be a possibility if you sold them for less than you paid. This is optional. It has to take, it won't be on every statement, only if you have treasury stock transactions that you sold at a loss and wiped out contributed capital. So it goes up and it goes down, and then it has an ending balance, and this ending balance ties to the balance sheet. So this ties to the last balance sheet, and this ties to the current balance sheet. And that looks for the world like the statement of changes in owner's equity and partnerships, except we have dividends instead of draws. There could be a complicating factor. If you had an error correction, if you make a mistake in prior periods, you might have to fix your retained earnings statement, and that would be very similar to this, and yet just a little different. You'd still have the same heading, but let's see how it would look if you had an error that you were correcting. Making a mistake on a past income statement doesn't give you permission to make a mistake on the current one. You have to fix where it would have been closed into, and that's retained earnings. So you'll still start with your beginning balance. It ties to last year's balance sheet. And then you would adjust it for what we'd call a prior period adjustment. And this is an error correction. And that could be positive or negative. And you would have an adjusted beginning balance. And in this way, you've let everyone know. It's a red herring, isn't it? Really obvious that you've made a mistake. And you have that adjusted beginning balance that you start from. And then you would add in your net income and subtract any dividends you paid and subtract treasury stock transactions if you have those. I'm leaving that off this example. And you would have your ending balance. So you can see where you started with your last balance sheet and where you ended with this balance sheet. And that then is the format of the statement of changes in retained earnings. There is something you might want to do with your ending balance. The ending balance of retained earnings is sometimes greedily looked upon by stockholders, hoping for a dividend. But you can appropriate part of that. And what that means is that you earmark part of that for maybe future plant expansion or something. And so you take the ending balance and you would make a note on it in the financial statements, most likely, where you would say, we're appropriating, let's do a little example, appropriating part of this balance, and you give an amount for future plant expansion. What that does is let your stockholders know in a very tangible way. It's not available for them to get their greedy little hands on. So this, then, is what our statement of changes in retained earnings looks like. We have learned most of the things that could be added in or subtracted out, but as we progress through our studies of accounting, we'll introduce those when they happen. Right now, it goes up for net income, down for dividends, and might be hit for treasury stock transactions and prior period adjustments. Let's move on now to the statement of changes in stockholders' equity. This statement is like a statement of changes in retained earnings on steroids. It does every single account in the stockholders' equity section of balance sheet in the same format: beginning balance changes, ending balance. Let's do a little memory jog. What lives in the statement on the stockholders' equity section? Where there's paid-in capital, where we have any stock we've issued. I've limited it to common stock and paid-in capital, and it says apart from common stock, but there could be preferred stock and treasury stock in here. So there's our first paid-in capital section, and there's a retained earnings section, and then there's a treasury stock section on my example. Now, let's see how I can make a statement of changes in retained earnings for just those, realizing there could be more. I'm going to do the statement of changes in stockholders' equity by listing every one of the accounts and the number of stock involved, too. And I'm going to list it across my statement. So I have my common stock in number, and then in amount, and then paid-in capital, eek, on common stock. I forgot it. Paid-in capital in excess of par on common stock. Look how much I've had to squeeze in. Put that on. Retained earnings and treasury stock, and then do it by total as well. So I have it kind of tight right here. Here's one column. Here's another column. There's my skinny she forgot column, my retained earnings column, my treasury stock column, and my total column. And then I'm going to start with the beginning balance, and I'm going to show everything I added in each column, and then I'm going to show everything I deducted. What might I have added? Well, I might have issued stock, and if I did, so we have our beginning balances here, and this ties to last year's balance sheet. And anything I added, I might have issued some common stock, so the number of common stock will go up, the amount will go up, and in all likelihood, paid-in capital in excess of par will go up. I will have also hopefully earned some net income, And that would be another thing that's added. So I would add that into retained earnings. I might have purchased some treasury stock. And I know this is a contra account, but I'm still going to add in the purchases because it's bigger now. And I would total everything I added in and included in this total. I would total up all the things I added on the net income line and added in. And I would total all the treasury stock. And I would put it there. Remember, that's a negative number. Then I would start with the things I subtracted, because I've already done the things I added into those various accounts. What have I subtracted? Well, if I paid dividends, that's going to come out of retained earnings, so I would show that here. And that would be the only place it could show up, so I would put it here. Maybe I sold some treasury stock. That's right, sold treasury stock. And that's going to reduce the amount of treasury stock I have outstanding. And it might very well reduce retained earnings if I sold it at a loss but couldn't call it a loss. These are examples of things that could drop these accounts. I would total the amount of treasury stock, total effects on stockholders' equity, and let's say that's it. So then I'm going to total these columns, and I'll have an ending balance that will tie to this year's balance sheet. The number of stock that's outstanding, the amount in my common stock account, the amount in my contributed paid-in capital in excess of par, retained earnings, treasury stock, and total stockholders' equity. And this column is an exact replication of my statement of changes in retained earnings we did above, because it is part of stockholders' equity. So this statement shows the change in every single stockholders' equity account. In the same format we've used to do all statement of changes in owner's equity. Start with the beginning balance, show how it went up, show how it goes down, and show how it ends. Not so bad, really. And that's the statement of changes in owner's equity. And again, it has the name, the business, what statement it is, and the period of time covered. Hey, finally, huh? Thanks for joining me. This corporation chapter is getting a little long. I think we only have one thing left to do, and we'll do it on a short pencast. Talk to you later.